Good evening, everyone. I hope you're all well. I'm here with Richard Smith tonight of Thrism Bookkeeping, and we're going to be talking all about bookkeeping within your business and how it can help your business. So, evening, Richard. How you doing?
Yeah, I'm good. Thanks, Bill. Thanks for having me.
That's all right. Thanks for joining us. Hopefully, we can share some really good value with our listeners and help them with their businesses. So, bookkeeping. What got you into bookkeeping? Tell us a little bit about yourself and your business.
Well, it was I never set out when I was going through school or anything to be a bookkeeper, but I had always had ambitions of having my own business. And a few years ago, my wife and I, well, more my wife really, started to make candles, scented candles, quite a common sort of kitchen table business, and selling them in local craft fairs. I said that I would look after the numbers and I'll do all the figures, because numbers is my thing. I'm a bit of a geek when it comes to spreadsheets. She's the creative type. So that all went all right. We didn't make a lot of money from it, but it got to tax return time. No problem, I thought. Tax return's got to be done by the 31st of January. I think we got to about the 28th of January, and I had a look at it. I thought, I need to put this together. And
right.
From that point, I just had my head in my hands. I just didn't know what to do. And we hadn't even hardly done any real trade really. So the amount of tax that we would owe, if anything, was so minute, it was almost pointless. But you've got to get these things done. And I just sat there and I thought, if somebody came along and took this away from me, I would gladly pay them 500 quid to do that. It didn't happen. Backwards and forwards with HMRC, got a £100 penalty because we were late. And then that was the end of the candle business. But it taught me a lesson. It taught me that actually, if I'm going to make a go of having my own business, this is something I probably could do with knowing something about.
Yeah,
so,
definitely.
With that, I enrolled in a course, a level 2 course with the Association of Accounting Technicians. And I learned about it, and I thought it was really good, actually. I really enjoyed the course. And as I was going through it, I thought, you know what, this is actually something that I enjoy. This is something that has some value, and this is something that I might be able to help others out, and hopefully not to have them in the same situation that I was in. So level 2 course turned into a level 3 course, and about 5 or 6 exams later, I applied for to the Institute of Certified Bookkeepers, and they granted me a practice license, which allows me to work in public. So that's been in place for a couple of years now, and going through that, and I've become a QuickBooks Pro advisor as well, taking some exams with them too. And so it's just about building on that knowledge then, and then helping people out. And I've got more exams to go and more things to learn. But some of the stuff that I've learned myself personally through this journey has been really useful, and it's really given me a good understanding of how businesses work and how that money flows through businesses, and what you need to do come tax time as well.
Definitely. And I've got to be honest with the people in the group. You're a QuickBooks advisor, and we've taken on your services to sort out our QuickBooks, because hands up, I thought QuickBooks would be really easy, and we just sign up to QuickBooks and sort out all our profit and loss and invoices, but it all went a bit wrong, didn't it?
Well, I think it's partly the fault of these software companies, because they do market it, and QuickBooks has got quite a strong marketing presence. Xero's another one. Sage is coming through now, and they all kind of market themselves as this super easy, super intuitive way of crunching through your numbers. And actually, there's a little bit of knowledge of what goes on behind the scenes would be really beneficial to a lot of people. And the training that they provide and the help guides that they provide doesn't really, I don't think personally, go deep enough into getting you to understand what's actually going on in the business. So yeah, it's been a learning curve, I think, Bill, but we're getting there.
That's it. You know, maybe I was fooled by these adverts and downloaded the app and just thought, yeah, I'll just snap away my receipts and I'll put in this, that, and the other, and it'll all be perfect. But it certainly wasn't. So, like you did, we're all learning, aren't we? And we're all learning the hard way. If that makes sense, a bit like you did with your fine.
Yeah, and that's it. And you know, every time something goes in and something's wrong, then there's a lesson to be learned there, and it's just about building up that experience, and as you go through it, you can sort it out yourself. And you know, I'm not trying to do myself out of a job, but I think we have to be realistic and say that, you know, bookkeeping and accounting software has come a long way in the last 10 years, and it's a lot cheaper than it used to be. But there is still that kind of the knowledge gap between just downloading some software and getting on with it, and actually knowing what's going on, because it's not like using Microsoft Word or something like that, which is quite intuitive and you can't really go wrong with it.
No, I know from speaking to some of the members within this community, they certainly leave their books until the very last minute. So hopefully this will be useful for them. So you've got a little presentation for us, which looks good. So I'll hand it over to you to talk your way through the presentation.
Yes, thanks very much. Yes, hopefully you guys that are watching will get some value out of this. And if you've got any questions at all, just shout up. If you're watching this on a replay, just type in the comments that you're watching it on replay. And if you have got any questions or anything, my email address is here, richard@thrism.com. Just drop me a line. No problem. If I can help you, I will.
Brilliant.
But without further ado, let's see what we've got in store. So actually, just this morning, I quite like reading business books. And so I was reading one this morning and I came across a sentence that said, the most dreaded word of every business owner, accounts. And I thought, is that true? Because obviously it's not for me, because it's kind of what I do, but I appreciate that my brain might be wired slightly different to others. I hope it's not the most dreaded word for you guys out there, but just in case, you know, it can be a little bit foggy, and so hopefully this presentation will help lift that fog a little bit, and you'll have a better understanding, and it won't be so dreaded come the end of this little talk. So just briefly, what I'm going to do is I'm going to talk to you a little bit about the history of bookkeeping. It's a very quick history lesson, but I think it's important because it puts into context where we are now with the industry. And then we're going to spend a little bit of time talking about the different types of transactions that you'll experience. We'll talk about the value that you can get from reports within your books. And I'm going to give you a little bit of a lecture about accuracy when it comes to actually filling in putting some numbers into your software, because accuracy is a really key part of the bookkeeping process. Then we've got everybody's favorite subject, tax. I will say here, and I'll remind you later, that I am not a tax advisor, but I do think there's some value in having some knowledge around how the tax system works and what are some of the numbers that you need to look out for. And then a common question that I get asked quite a bit is, what's the difference between a bookkeeper and an accountant? Do I need a bookkeeper? Do I need an accountant? Do I need both? Or do I need neither? And the answer is yes to all of that. But hopefully I'll help demystify some of the differences towards the end. Okay, so as promised, we have a very short history lesson. This guy here in the middle is a guy called Luca Pacioli, and he was an Italian monk and mathematician that lived about 500 years ago. And he would watch merchant ships come in off the Mediterranean and then do business with local traders. And he is the one that kind of formalized a way of tracking money that goes through those businesses. And it was kind of named double entry bookkeeping. And in 500 years, this system has yet to be broken, and it's still the backbone of global accounting systems all over the world, from Google and Apple right down to your business and every business in between. This is a fundamental thing. So when things don't quite work out as you expect in the software, it's because what's going on behind it is 500 years old, and it does work. But you'll have to realize that there are millions of people across the world that have had very good careers from studying this sort of stuff for many years and working in the industry for years and years and years and years. And so some of it can get a bit complex. Okay, so one of the important things that you'll have with your bookkeeping system is what we call a chart of accounts. And this is basically an account for everything. So whenever you spend any money or you have money coming in, everything has its own kind of category as to where it goes and how it gets recorded. When I first started learning about this, I thought, you know, why are we calling them accounts? So I have to go and get a bank account for all these different things. That's just a name that they're given on. Think of them more as categories, and they are imaginary, if you like. Obviously, in days gone past, you would write them all down on pieces of paper and in books, but they are like categories. So you would have, we'll talk a little bit about what we've got in a bit, but you have to realize that with the double entry bookkeeping, each transaction that comes through your business will impact on at least 2 of those accounts, so 2 of those categories. But make it work for you. So when you download your software or you come up with your bookkeeping system, even if you're going to do it manually, you need to make it work for you. So if you download a bookkeeping system like QuickBooks, it will give you a predetermined set of a chart of accounts. Some of them you'll use, some of them you won't use. You can add to them, you can take stuff away. But there's a balance to be had. You don't want it too bland that it doesn't really make a lot of sense. But at the same time, you probably don't want it too detailed that it's overly difficult to manage.
So are you going to go into the categories, or you have like a category for like shampoo and stuff like that?
Well, you might not necessarily have one for shampoo because that might be like accessories, or, you know, your cost of sales equipment, kind of disposable stuff. But I'm just going to quickly mention the categories of money that you'll experience, and then we'll talk a little bit about some of the categories of the charts of accounts. So just bear with me, but good question. Okay, so there's a few different types of money that you'll experience in your business and how it's divided up. We have assets and liabilities, income and expenses, and they all perform a different role within the business. There's actually another couple, capital and drawings, which is the money that you put in and is owed to you, and the money that you take out of the business. I'm not going to talk massively about those because you'll spend most of your time dealing with assets, liabilities, income and expenses. So when it comes to your assets and liabilities, these are all feature as accounts within your chart of accounts. And assets are stuff that has value to the business. It's stuff that you can convert into cash. So your bank account is an asset. A savings account is an asset. If you invest in some pretty meaty equipment, that could be classed as an asset. So if you were to sell it, you could convert it to cash. And debtors, that's another way of saying people that owe you money. So if you sell any goods or provide a service on credit while they haven't paid you, they're listed as a debtor, which is also an asset. So if the worst came to the worst and you had to cease trading tomorrow, you would set about converting everything into cash. Mm-hmm. And on the flip side of that, you have liabilities. Now, your bank account could be a liability if it's overdrawn, but more common liabilities are stuff like credit cards, loans, and suppliers that you have yourself that you've bought goods on credit terms with. So if you buy something and they expect payment 30 days later, that is listed as a liability within your business.
Would like a lease, if you've leased your shop or leased a van, would that be a liability?
So that might be, it depends on the terms of the agreement, and how you would exit that. If you were to exit the lease and you would have to pay the rest of the term, then that would probably be a liability. But if you've just sort of hired something, then it might just go as an expense.
Okay.
But what it gives rise to is this equation, which is known as the accounting equation: assets minus liabilities equals capital. And basically what that says is, if you cease trading tomorrow and you realized all your assets into cash and then paid off all the liabilities, then what you're left with is what the business owes you. That is what's known as capital. And hopefully that's a positive number. It should be.
So that's the sort of money, that's the number that you're walking away from your business if the worst came to the worst, or do you always use that within your business to sort of find your profit? And
no, you wouldn't really use that for profit, and there's a reason for that, which we'll come to. But the assets and liabilities get listed on a balance sheet, which we'll talk about later, and then income and expenses. This is talking more about your profit. I mean, really simply, income is just sales. So that's the money that comes into your business through selling your service or selling the goods that you have. You can add them all up, and that gives you how much money you've got coming in. The expenses, though, that can run into many different accounts, and you would have an account for advertising, one for insurance, one for staff, one for rent, one for fixtures and fittings. You'd have one for repairs to stuff. You'd have one for just general office expenses. You might have a stationary one. It depends on the size of your business, but you can have hundreds of these, literally. And what you would do with this is another equation, quite a simple one. Take your income, add that up, add up all your expenses, and take the expenses away from the income, and what you're left with is profit. Now, it does kind of link in with the assets and liabilities, because hopefully your profit goes into your bank account, which is listed as an asset. And so that will increase in value as your profits increase as well.
so with so with the I don't know if you go into this in a bit, but when you do your tax return, I've never done a tax return myself. I've always used I've always outsourced it. But are they, with your sole trader, they expecting you to put all of the assets and liabilities onto that tax return?
No, it depends on how much. Generally speaking, not. If you purchased equipment that's like cost quite a bit of money, it might be prudent to list that, because there's slightly different tax rules around that kind of thing for with allowances for buying equipment, plant and machinery.
Yeah.
But you wouldn't normally have to do a balance sheet or a profit and loss either, although I can't imagine how you can do a tax return without running a profit and loss at least. With a limited company, it's slightly different, because you're legally obligated to do a balance sheet at least once a year in your end of year accounts, and it's advisable to do a profit and loss as well. But there's no legal requirement for a sole trader to go into that level of detail. That said, it's still a really useful exercise to go through, because you want to know what your business is worth.
Yeah, definitely.
So just to track how the money goes through the business, and we talked about double entry bookkeeping, and essentially what we want to do is balance the debits and credits. Don't worry too much about that at the moment, but hopefully you'll see here. So within your chart of accounts, if you were going to do it manually, you would draw up what we call T accounts, and you would list debits on one side and credits on the other. So let's say we spend £300 from our bank account, and we spend it on advertising. We need that to balance with somewhere else within our books. So the bank account, the asset has decreased in value by £300. And what we would do is we record the same transaction within our advertising, our expense count, but on the debit side. So the advertising expenditure goes up by 300. Credits equals debits. We're happy with that. Now, if you make some sales, and let's say we just make £400 in sales, our sales income has gone up, and so has our bank account. So again, we have credits and debits, and they both have to cancel each other out. And it's quite useful actually doing it like this, because over time you will add up what you've spent from the bank and what you've received into the bank, and then hopefully that's a positive balance. But when you break it down and look through other things, you can just have a quick glance at your advertising account and see that you've spent £300 on advertising. You can have a look at your sales account and you can see that you've spent £400 in sales. You can look at your rent account or your fixtures and fittings account, any different account, and quite quickly see exactly how much money you're spending on these different aspects of the business. So it's really important to keep that up to date and keep on top of it, because it all feeds into some reports. So we've been talking a little bit about the balance sheet, so let's have a look at that. So what a balance sheet is where it lists assets and liabilities, and it shows a snapshot of the health of your business. And by that I mean you would say, on such and such a date, here are all the assets and here are all the liabilities, and this is what the business is worth. It's a key component in the valuing of the business. Now, it isn't the only thing that's taken into consideration when valuing a business, but it's often like the starting point of how much the business is worth. And like I just mentioned, there's a legal obligation for limited companies to produce this every year as part of their final accounts. So just real quick, this is how it goes together. And the idea is that you can put all of this information on a single sheet of A4. And so with this and the profit and loss, you get a really good understanding of where the business is with just 2 sheets of paper. So with a balance sheet, you would list your assets at the top, and this is a simplified version. But you would list your assets at the top, and then your liabilities would go on the middle section, and at the bottom you would basically do the calculation that shows how much it's all worth. So in this case, we just made up some figures, but we have capital in the business worth just over £26,000. So the theory being, if you cease trading tomorrow, realised all your assets, paid off all your liabilities, that's how much money you'd walk away with. So the other side of that is the profit and loss. Now, I really like profit and loss because I'm a little bit more geeky when it comes to data and comparisons and all the rest of it. But this is one that shows the performance of the business over a period of time. So as a limited company, you will probably do it an annual one as part of your final accounts. But there's nothing to stop you from doing this weekly, monthly. I would suggest you do it at least quarterly. And it allows you to compare. So if you do it for a quarter, you can compare that quarter to the previous quarter. You can compare that quarter to the same quarter the previous year and the year before that. And it gives you a good idea of how the business is progressing.
I think also it's a really good idea to look at this regularly, because it also tells you how much you might be having to save to pay against your profit, if that makes sense. How much you might have to save for tax.
Yeah, and because that's a really important thing, and I've put there on the top line that the profit and loss actually forms the basis of any tax calculations that you do. So if I show you one, again, a simplified version of what a profit and loss statement looks like, again, a single sheet of A4, it tells you all about the business. But what you would list is the top line. So when people say, what's your top line? They're talking about sales, the income, the revenue that you've generated over that period of time. And like I say, this could be a week, a month, a quarter. You'll have to do it for a year to work out tax, but you can do it however you want. But the top line is all your sales.
Yeah.
And the next line that comes in is your cost of sales. So this is items that you've had to purchase in order to conduct the business. So I know, Bill, you do, you clean dogs' teeth, and so you need toothbrushes for that. You can't provide that service without buying toothbrushes. So the toothbrushes would be a direct cost of your sales. So you would add up that throughout the year, take one from the other, and you get your gross profit for the year. But now on top of that, you have to add in all the other expenses that's been going on. So that would be summarized, but you would also break it down as to, back to your chart of accounts, all of those expense accounts, you would list them all and what the balance was for that period. So just some fairly typical stuff, but advertising 750, we've got some £4,000 worth of fixtures and fittings in the shop, some staff costs as well. And you add up all of that, and we have £23,000 of expenses. And so the bottom line, when people ask you, what's your bottom line? They mean, what are you left with after that period of time? And in this case, we've got a £17,000 profit after taking all the expenses away from the gross profit.
It goes to show, doesn't it? Sorry, it goes to show that if you keep an eye on your expenses, how that can really affect your profit at the end of the year by being quite tight on keeping track of everything.
Yeah. So the whole point of being in business is to raise a profit, and you know, this number here is really important. Now, the bigger it is, the more tax you have to pay. But let's just get over that for a second and just try and make that as big as it can, so you can be as comfortable as we possibly can. And there's 3 ways in which we can alter this and make that bigger. And the first way is to increase your sales. Just sell more stuff, get more customers, or raise your prices. They'll both have an impact on getting more money coming into the business. The second thing that you might be able to do is actually those direct costs that you are incurring on actually providing that service. Is there a way that you can make that process more efficient, or is there some sort of deal that you can come to with a supplier to lower that cost? If you just lower that cost by 10%, then that's going to save you £1,000 straight off the bat, just for in this example. Mm-hmm. And then the third thing is keeping an eye on those expenses.
Yeah.
So there are 3 things that you can do. But what I would say is spend major time on stuff that's going to have a major impact, which is up here, your sales, and spend minor time on stuff that's going to have a more minor impact. Because if you think about it, you can shop around for insurance deals and it might save you £100 here or a couple of £100 there. It's not going to have a massive impact on your bottom line as much as increasing your sales will. So major time on major things, minor time on minor things. So review this probably every 6 months or something, see if you can cut some fat away from it, but spend the majority of time, I think, probably up here looking at more efficient ways of doing the business or increasing those sales.
Excellent.
Okay. Oh, didn't mean that. Let's just rattle through this bit again. Okay, so, oh my God, accuracy is key. This is so important, especially if you're going to be doing your own bookkeeping. If you can't keep accurate records, then all of those reports, the value that you get out of them diminishes greatly, because you have to have accurate records so that you get accurate information. And the more accurate the information is, the better informed you are about the state of your business and the better decisions that you can make. And it's so easy to make little mistakes with it that can have actual quite major repercussions throughout the whole of the system. So I've come up with the Rich Smith 3 rules of minor time on minor things. So review this probably every 6 months or something, see if you can cut some fat away from it. So I've come up with the Rich Smith 3 rules of minor time on minor things. So review this probably every 6 months or something, see if you can I think what's happened is that I'm getting some feedback. I don't know if the connection dropped out a little bit.
Sorry, no, that was my fault.
Oh, was it?
See, it's key.
It's really off-putting hearing myself talking about something
I
not
know.
talking about.
Sorry.
All right. So we've got the Rich Smith guide of everything gets recorded 3 times. So follow these rules. Always bear them in mind. And that is a good starting place to make sure that your records are accurate. Okay, so you will have some paper evidence that something has happened. So when you buy something, when you spend money on an expense, you will receive a receipt or an invoice from the supplier. That is your evidence that something has happened. You need to keep that for 6 years. That's one of the rules stipulated by HMRC. So that could be a paper record, or it could be a PDF on an email, something like that. HMRC are quite happy for you to keep digital copies. And by that, I mean, you can even get a paper copy and scan it or take a photograph of it and keep that digital copy of it. But you still have to keep it for 6 years. You need to make a record of where the money to pay for the thing came from. So did it come from your bank account? Did you pay for it with a debit card or with a credit card? Or did you pay cash? You need to make sure that you record exactly where that came from. Now with one of the benefits of using your bank account and a debit card is that the bank automatically keeps a record of that on your bank statement. So whenever you can use a debit card or a credit card, I would say use that. When you start using cash, it gets a little bit messy because you have to keep a manual record of that. But there are 2 of the things. So far, we have an automatically generated receipt or an invoice that all you have to do is keep hold of it. And you've spent some money and that's recorded on your bank statement. So that's automated as well. So that's nice and easy so far. So can anybody guess where the problems might have started arriving?
QuickBooks.
QuickBooks or Xero or Sage or spreadsheets or whatever it is,
So
where humans take
I
over.
just asked a question about the cash thing. So if you say you've got an invoice or you've paid something for like £5.99, you've paid by £10, you paid by a £10 note, you then have to record all that change, don't you, somewhere?
So what I would do is, if you're going to be making small purchases like that, it's handy to have a little cash flow. So like a petty cash or something like that, and have a cash book, so that when you paid out £10, you just make a note, say, I made this purchase for £5.99, and then you get your change and you put the change back in the bag, and then that's all sorted, and you keep track of it that way. But it does, you do have to do that kind of manual part of it, because obviously it's not automatically recorded, and that's quite a common area where people start to lose track of what's going on, because that, you know, £4 and a penny that you get in, that kind of finds its way, you know, somewhere else, and then it's gone, it's disappeared, and we still have to try and keep track of it, because all the time we have to make sure that debits equals credits. So this is the problem. This is where issues start arriving, when humans get involved in actually making some records here. Now you might use a spreadsheet, you might use some specialist software. I think probably before too much longer, vast majority of people are going to have to use specialist software. And that's because of the government's drive with making tax digital. At the moment, VAT returns, if you're VAT registered, you have to submit your VAT return through some MTD compliant software. So QuickBooks is one, Xero, Sage, all the main players are. And really, there isn't much of a way around that. And over the next few years, there's going to be more forms of tax that come online with that. I think self-assessment's due to come in either next year or the year after, and eventually corporation tax returns will have to be done the same way. Now you can have your own spreadsheet if you really want it, but you have to get it to be able to communicate with HMRC. So it needs some techno wizardry to do that, and it might just be worthwhile investing in some software. A lot of these cloud-based software providers like QuickBooks you get set up for anywhere between sort of £15 and £35 a month, depending on what your needs are. So it's not a great expense certainly compared to what it was probably 10, 20 years ago. You know, it's here to stay. There's no getting away from it. But you have to record it into your bookkeeping system and link those other bits up. So your paper evidence, where the money came from, you combine all that, put it into your bookkeeping system.
I think accuracy, like you said, is the key, because you don't want to get to the end of your year and suddenly find you've made a lot more money than you're accounting for and got a big tax bill, or vice versa, you've made a loss without appreciating it.
Yeah, absolutely. And this is the thing. This is why it's so important to try and stay on top of it, because mistakes do happen. I mean, you know, we're all human at the end of the day. I make mistakes, but it's just about trying to identify them and minimize them. So some like the most common mistakes that I've come across are when you're recording it, you incorrectly record where the money's been spent. So you've gone and bought something with your debit card, but when you've come to record it, you've actually recorded it that you've spent it on your credit card. So when we go back to our assets and liabilities, the asset, which is the bank account, our bookkeeping software thinks that it's artificially high because it hasn't accounted for the spend, and the credit card, we've got an artificially high liability because we're telling the bookkeeping system that we've used the credit card. So that can straight away it skews all the figures out of sync. Really another common one, just mistyping the numbers. Certainly if you're going through a lot of transactions, you can get a little bit number blind. You put the decimal point in the wrong place, you put the numbers the wrong way around, you miss a zero off. It can throw the whole system off if you don't double check it there and then. And a really common one is putting the wrong date on. And I know certainly with QuickBooks, if you're putting through a lot of transactions and you're doing it kind of manually, QuickBooks will auto-populate the date with the last time that you put an expense through. So if the date changes, you have to change the date, and that can also throw the system out of kilter as well, because you don't want to show profit for 1 month that actually happened in this month. So it's really important to try and keep on top. So when you're inputting this stuff, double check this stuff as you're going, and a little bit of, you know, taking 5 seconds to just scan your eyes over these will save you hours of work potentially in the future.
And again, you know, you get these, you know, QuickBooks and other providers are saying, you know, just do it on your app. You can do it while you're cooking dinner, and then you start bleeding in all these mistakes, don't you? And then they all start escalating.
Yeah, and there's a big push as well. A lot of them are coming up with these automated tools. You take a photograph of the receipt, and it magically puts all the data into the software. In my experience, it works sometimes, but you should always be double checking it, because if it doesn't read the numbers quite right and it puts the wrong number in, or sometimes it doesn't know how to categorize an expense. It might read the supplier, and you'll say, well, most of the time when you purchase from this supplier, it's this expense, but actually on this occasion it's something else. So even if you're going to try and automate as much of that as you can, you still need to double check it. I don't think the software is that sophisticated yet. But if we're going to double check it as we go along and spend a few seconds doing that, a really important thing to do is bank reconciliation. And this is like a triple check. And so what I mean by this is every month that your bank will give you a bank statement of all the activity that's happened in your bank. They might send it through the post, you might have to download it, but do it. And what you need to do is you put your bank statement on one side and you have a look at your bookkeeping records on the other, and you just go through it line by line. You know, bookkeeping software can actually do this for you quite quickly, and it is pretty good at doing that, and it highlights the errors. But essentially what we're going to do is we'll have a look. Transaction A, that's on the bank, it's in the bookkeeping records, happy with that. Transaction B, no problem. And then you'll come up to a line in your bank statement and you've got no corresponding bookkeeping record. So at that point, we need to do a little bit of investigation, and we'll find out that it's either not been recorded at all in the bookkeeping system, or there's been some sort of error with it. So we need to try and find that, correct it, so that it marries up with the bank statement. Transaction D is fine, transaction E is fine, but then you get to the end of the list and you've got one left over in your bookkeeping records that doesn't show in the bank account. So again, we'd need to investigate that. And quite a common one would be you've put the wrong date on it. So it's trying to look for a transaction that didn't occur during that time period, or you've spent on the credit card when you should have and recorded it as a debit card, and that's where you need to adjust the source of the funds. Really important though, reconciliation. I can't it's enough.
I'm just sitting here just thinking, oh my God, it just takes so much time. And it's supposed to be such a sort of simple business model. You get money in from your grooming, and maybe you pay money out now and then.
Yeah, and that's it. And but to be honest, if a lot of your transactions are automated and you've got an electronic copy of it, if you get the bookkeeping process right and you stay on top of that, then this literally takes 5 minutes. But get into the habit of doing it regularly. Do it monthly at least, and don't leave it for more than 3 months, because as a bookkeeper, if you come to me and you're more than 3 months out of date, then that changes the type of job that we'll be doing, because it becomes more of a tidy up or a rescue job, to try and get things straight again. And correcting an error that happened last week is a lot easier than correcting an error that happened 3, 4, 5, 6 months ago. And so we need to stay on top of it. And so just get into the habit. If you're just starting out and your business is small and you don't have many transactions, there's a temptation to just let it go. I keep track of it in my head. Don't. Sit down at the end of the month, 5-10 minutes, just do this, get into that habit. It's a really good habit to get into, and it's that triple check that makes sure that your figures are right. And if your figures are right, then the information is good, and then you can make better decisions for the future of your business.
Definitely. And I can hold my hands up and say, if you don't do this properly, it costs you money. It costs you money to get it sorted out. And I've learned the hard way doing that.
Yeah, absolutely. Because, and you're not alone. It's quite a common thing. People do sort of let it slide for 3, 4, 5 months, and then it gets towards cash and tax season, or it's just not making sense at all. And then you're left with, well, where on earth has it gone wrong? And you just don't know where it's gone wrong. And that's perhaps when you need to start hiring in people. And honestly, that's an expense that you could probably avoid just by taking that little bit extra time, just checking and then double checking and triple checking those transactions as you're recording them.
Yeah.
Right. Everybody's favorite subject, tax. It's quite an emotive thing. I don't know if anybody watched the budget last week. Some changes on the way. But you have to remember that the aim of the game with all this tax stuff is that you just have to pay the right amount of tax. There is a lot of legislation that dictates how much tax you need to pay, and it can get a bit complicated, but it's worth knowing some of the figures that are out there, so that you can just stay on the right side of doing this, because if you get it wrong, you might end up paying too much tax, which can have a negative impact on your cash flow. HMRC will probably give you the money back. I don't know how long it will take, but you want to keep hold of that money if you can, because cash flow is so important to businesses, especially in these uncertain times. And definitely don't pay too little, because I'm sure the people that are watching this will understand that Facebook, they know lots and lots about you. Google, Apple know lots and lots about you. HMRC know lots and lots about you and your business without necessarily you knowing. So as pet groomers, HMRC will know how much money pet groomers make and how much tax they're expecting to receive. And if you submit your tax forms and you strike out as a bit of an outlier, if you're not paying, if you're below the average by any great way, then they'll send the taxman round to inspect your books. And that's why you need to keep your stuff for 6 years, because that's how far back they can go. And if you've got it wrong, they'll want you to pay it, probably with interest.
I think that's probably one of the biggest things that causes businesses to go under is failing to save up money for your tax bill and your, especially your VAT bill. You know, customs and excise and HMRC are so powerful, aren't they?
They really are powerful. They can do a lot of damage. They're not really your friend. They're there to take your money. I think it's probably, you know, nobody really likes paying taxes, but it's an important part of society that we live in. You know, the roads and the schools and the hospitals and the police and everything, it all needs paying for. So I think from my point of view, I'm at peace with it now. You know, you just have to embrace it, don't you? And put some money aside. So when you've got money coming in, what I tend to do, and this might work for some of you, might not work for some of you, but I try and put 25% of the money that comes in to one side in a separate account. So when it comes to paying taxes, I can just go straight to that account and the money should be sufficient to pay it. And if there's anything left over, that's money for me that I can have. And the business is paying my taxes, and off I go. And you know, it's going to be there or thereabouts. So 25% kind of works for me. You probably need to be somewhere in that ballpark, particularly if you're VAT registered and you get these quite regular tax bills that come through. But so do that and take some steps. So set up another account, set up an account where you can put this money, and it's difficult to get to, because what you don't want to do, you have to identify that is not your money. That money belongs to HMRC. You're just holding on to it until you have to hand it over. If you spend it, they're still going to want to get paid. So embrace it.
Yeah, and I think what I always say, you know, if you're paying tax, your business is doing well, you're making money and you're making profit, which is good. It's a good
Absolutely. It's nothing to be scared of. And it is a form of success. So embrace it and be prepared for it and plan for it. It's not a problem. But there are a few different types of taxes that you should be aware of. And I'll kick off with income tax, because I think that's quite an important one. So everybody will pay income tax. If you're self-employed, you operate as a sole trader or in a partnership, then your profits from the business will be subject to income tax. If you run a limited company, it's slightly different. But when you take money out of the company and it lands in your lap, then it's likely to be affected by income tax. So what I've done is I've just put a little diagram up here. Everybody gets a personal allowance. Now, in the budget last week, they announced that the personal allowance is being increased by 70 whole pounds, and it's going to be £12,570. Anything that you earn below that is free of income tax. That is a tax-free allowance that everybody gets. After that, you become, if your final income is under £50,000 and now £270, then you are a basic rate taxpayer, which means that all of that income in between those two numbers is taxed at 20%. And this is probably a good time to introduce stuff about dividends, because if you're a limited company, you can pay yourself in dividends as well as a salary or instead of a salary, however you want to play it. But essentially, the dividend tax bands mirror the income tax bands, except with dividends, the first £2,000 of dividends that you take is tax-free. So this is on top of your £12,500 here. So potentially £14,500 tax-free income. And then within the basic rate band, tax on dividends is just 7.5%. So if you just paid yourself in dividends, anything over 14,570 is taxed at 7.5%. More on that in a bit, because that's not quite strictly true, because you have to pay corporation tax before you can access that money. But we'll talk about that in a sec. So above that, if you're starting to earn a bit more money, above 50,000, then you become a higher rate taxpayer, and anything that you earn over that number is taxed at 40%, which is a bit of a hike, and an even bigger hike with the dividend. That jumps up to 32.5%. And for those of you that earn more than £150,000, you become an additional rate taxpayer, 45% or 38.1. Just one other thing that I would mention in here, if you are going to be getting up towards this area, you go above 100,000, then your personal allowance starts to be eroded. And once you get to 125,000, you don't have any personal allowance left, so all of your income would be taxed. But you know, that's a first world problem to have.
Yeah, that needs some planning.
Yeah, and that's where you would need to probably want to speak to a tax specialist and get some advice on that. So just to recap, income tax is levied on your total personal income. So that is your income from your business, if you've got a job, a pension, any property income, savings can add towards this as well. And it's all added together, and that gives you your tax band. So don't forget that you are entitled to just over £12,500 as a personal allowance, and then everything is taxed at 20% until you hit the £50,000 mark, and then it goes to 40%. If you're an investor in companies, or you've got your own company, then take advantage of the £2,000 dividend allowance, which is on top of personal allowance. So here goes with national insurance.
Mm-hmm.
Just briefly, because this gets quite complicated. I think this is something that I struggled with when I was studying it. But basically, if you are an employee, and that includes if you are an employee of your own company, this is not self-employed. If you are a salaried PAYE member of staff, then you will pay Class 1 national insurance on anything you earn over £9,500, and that's 12%. If you are an employer, and so if you run your own company and you work for your own company, you are also the employer, and you have to pay 13.8% contribution on anything over and above £8,784. Now, that's worth bearing in mind. If you are looking at taking on some staff, that is an additional cost over and above their published salary. So when you are budgeting for this sort of thing, bear that in mind. 13.8% of anything they earn over that 8,750 is goes off to the government on top of their salary.
Yeah.
So if you are self-employed, if you have opted to go for being a sole trader or in a partnership, you should be aware of Class 2 contributions. That's a flat rate, currently £3.05 per week, about £160 a year. These are voluntary if you make less than, I think it's about £6,500, compulsory if you make over that. And this is the important one, because this pays for your state pension and some other benefits that you get from the state, maternity pay, that kind of thing. So you need to keep up to date with that. So even if you're below the threshold, I would probably urge you to just pay that money.
So if you're self-employed and a sole trader,
yeah,
that's all the national insurance you pay. There's no percentage of your I suppose you're not paying a salary, are you? So that is just right.
No, it's not that straightforward, because this is where class 4 comes in. And Class 4 national insurance is a percentage of your profits. So again, it's that around that £9,500 mark, which is the same for employees. But you'll notice here that actually the percentage that you have to pay is lower. It's 9%. And actually, what I would say is there was some suggestion that in the budget they might have looked at this and raised that to maybe 11 or even 12%. but they didn't. And I think it's got something to do with the Conservative Party manifesto. They pledged that they wouldn't increase national insurance or income tax rates. So that seems to have been saved at the moment, but one for the future, perhaps that would be, out of all of this would be the one that probably goes up. So if you're self-employed, you get two. You get class 2 and class 4, but you don't have to worry about class 1. There is a class 3. That's a flat rate, £15 a week if you've missed national insurance contributions previously. So you can bridge those gaps in your payment history.
Like a top up.
Yeah.
There is a way, I think if you go onto a government website, you can actually log into your account and see whether you're up to date with your national insurance or not, isn't there?
Yeah, you can. If you just Google national insurance contributions, a couple of clicks, and you can go and have a look at your record. So corporation tax is a biggie one, and it's hit the news this week with the budget. And this is tax on your company profit. So if you have a limited company, your limited company is a separate entity to you. And companies don't have the luxury of like a personal allowance like you personally do. And what that means is that for all of the profits that you make, regardless of how much it is, currently you pay 19% to the taxman through corporation tax. Now your dividends that you pay 7.5% tax on are after this. So you have actually already paid 19% on those profits, and then there's an extra 7.5% when you take it. It's still not a bad thing to do, not a bad way of going about it. It's quite, in fact, that throughout Europe and stuff, these are really low rates. But you would have heard in the budget last week that they are going to be tinkering with the corporation tax rate. And what they're saying is that in 2023, they're going to raise it to 25%, but only for companies with profits over £250,000. And what I would say on the back of that as well is that they often give dates in the future as to when things are going to happen. And then when we actually get there, they get pushed back, or they are completely done away with. So who knows if it'll actually happen, but that's what they're saying at the moment, and that's what companies need to be geared towards. There's a bit of a, we don't know exactly how it's going to look, but they're saying that if your company makes less than £50,000 profit, you'll carry on paying 19%. Yeah. Now, if you fall between the 50 and the £250,000 profit, they're talking about a tapering, but I don't know what those figures are. They haven't explained exactly what that taper is going to look like. But something to bear in mind, because there will be people in here that will be affected by this.
Yeah, it'll be definitely sole traders looking to go into limited companies.
Yeah, and because, and you know, it puts a bit of a spin on it, because if you're going to be making good money like that, if that's the level of profit that you're going to be doing, then you know, you would probably be better off speaking with a tax specialist as to exactly how this is going to affect you, because it's a 6% jump in tax. That's quite a jump. So watch this space, I think, with regards to that. The government can do this. If they want more people to be self-employed, they will probably raise corporation tax and lower maybe income tax or that national insurance, class 4 national insurance. But if they want people to start limited companies, then they would drop down the corporation tax. I think at one point they said that they were actually going to drop corporation tax down to 17%. Yeah. But that's obviously gone out the window now. But that's another example of, they say that they're going to do something, and then when it actually comes to it, they don't. So just, you know, take it with a pinch of salt, and we'll see what happens, how it plays out over the next couple of years. Okay, so the last thing I'm going to talk about is the question that I get asked: do I need a bookkeeper? Do I need an accountant? What's the difference? Can I have both? Can I get away with neither? And what I would say is, you might need a bookkeeper, you might need an accountant, you might need both, you might need neither. it depends on your circumstances, but I think if you've got an understanding of what the roles are, then maybe you can make a better informed decision. So historically, bookkeepers would deal with the day-to-day transactions as they come through your business. You would keep a note of what money is being spent and what money is being brought into the business. And they would prepare those figures into a good order and give them to the accountant, who would then take care of all the tax affairs and sit down with the business owner and plan strategically where the business was going to go. So at one end of the scale, you have the bookkeeper that does the day-to-day stuff. At the other end, we still have accountants that do strategic tax planning, they do audits, they do forensic accounting, there's quite a few specialisms that are pretty high value tasks. Not all businesses need all of this stuff. And over the last 10 years or so, with couple of things have happened in the industry. One is we've had much more affordable, good software come to the market, which encourages people to do their own bookkeeping. And bookkeeping in general and accounting has become much more regulated. And so there are more rules and regulations around it. To become a bookkeeper now, you need to show that you have qualifications and or experience and have a practice license as well. It used to be the case where you could just wake up one morning and decide that you're going to be a bookkeeper or even an accountant and literally set up shop there and then. And I think probably what that's done is upskilled bookkeepers over the last decade. And it's shifted accountants more towards that strategic end of things. And there is a bit of a grey area in the middle where the lines have been blurred a little bit. And so it depends. Everybody likes being able to speak to one person and getting everything done with one person. But what I would say is if you go to an accountant, they might not necessarily do the bookkeeping, and they might outsource that bookkeeping to somebody like me, or they might have their own bookkeeping department. If you go to a bookkeeper, they will get involved in the day-to-day stuff, and they might also be able to do your tax returns. And a fully qualified bookkeeper can actually do limited company returns, providing you are a micro entity business, which has a definition in law, where essentially your turnover is under £632,000. If that's the size of your business, then you might be able to go to a bookkeeper and get that end-to-end service. If you're a bigger business than that, then you'll certainly need an accountant. If your personal tax affairs are fairly complex, if you've got lots of income streams coming in, I'd probably advise to go to an accountant who can advise on those tax issues. If you're looking at making particularly big purchases for your business and you want to know about how to shelter some of that from the tax man, again, the accountant's probably the best way to go. But either way, you have to realize that the day-to-day stuff, the bookkeeping, yes, you can do it yourself by all means. You use QuickBooks, use Xero, do it yourself. But if you want to get somebody to do that for you, then they might be getting quite involved in your business. And it's not unusual to actually end up paying a bookkeeper more than you would pay an accountant. And I think there's been a little bit of, I think, an underrepresentation with bookkeepers always seem to be the cheaper option. And yeah, the hourly rate might be lower than if you hired a chartered accountant, but they'll probably do more hours because they are getting their hands dirty and helping you out kind of on the front line, if you will, and sorting out the stuff. Whereas whereas an accountant might just look at end of year stuff or help you out with a couple of bits, maybe like with VAT and stuff every quarter. So it's one for you to decide, what do you need for your business? Do you need help with the day-to-day, or are you on top of the day-to-day stuff? If you're on top of the day-to-day stuff, then look for an accountant that can do the tax returns and some of the more strategic stuff going forward if you're looking at growing the business. But if you just need help with the day-to-day stuff, you might be able to find yourself a bookkeeper that can do all the tax returns that you need them to do as well. Most bookkeepers will be able to do self-assessments. So if you're self-employed, or in a partnership, most bookkeepers will probably be able to do self-assessment stuff. It's the fully qualified bookkeepers that will do the company's house bits and pieces.
Yeah, I think for a lot of pet groomers, it's a decision about, it's trading that time for money, isn't it? This stuff, you know, it can be a daily activity, or you know, you're going to have to sit down on a Sunday and allocate some of your Sunday to sorting out your books and reconciling your transactions for the week or for that month. So a lot of it, for me, it comes down to how much time am I willing to commit to doing these books, against how much money am I willing to spend to have someone else to do it for me, if that makes sense.
So something has to give. If you're going to do it yourself, something has to give. You either give up time working in the business and potentially, you know, doing this stuff is not an income generating task. You're not going to make any money from doing this. It needs doing. But you'll have to take time away from making money, or you take your time away from your free time. You cut back on your family time, your TV time, your hobbies, you know, whatever it is that you want to do. Because look, you know, one of the things that I say is you might not need a bookkeeper, but you do need bookkeeping in your business. And so it's got to be done. So you have to make a decision whether you want to try and do it yourself. And I know that certainly from my point of view, I'm more than happy to help people do it themselves. I have a range of support packages where for a small fee I can keep you on track and tell you what needs doing and keep you on the straight and narrow without having to pay big monthly fees or hourly fees to actually get somebody else to do it. Because in theory with the software it should be fairly straightforward as long as you're set up right and you're going in the right direction. Just having somebody there to help out, keep you on track, should work out. And I've just put up here a very quick checklist. When you're looking around, when you're shopping around for a bookkeeper or an accountant, do check that they've got AML supervision in place, which is anti-money laundering. It's a legal requirement now for people working in the sector. And it usually comes from, so like Institute of Certified Bookkeepers are my supervisor, and they insist that I do a certain amount of continuous professional development every year and keep on top of what's going on, and they encourage me to do more and more exams so that my knowledge increases all the while. But also, you know, be clear on what services they're offering as well. You can go to some people and you need payroll and they don't do payroll. Well, is that something that you're happy to outsource somewhere else, or do you want it all housed under one roof? And also talk to them about what they specialize in, the businesses that they're interested in helping. And because I know some bookkeepers that absolutely love working in certain industries and won't touch others with a barge pole. And so it's really very handy if you have your chosen professional that helps you out with this stuff, if they have actually an interest in your business and they understand your industry. That is worth its weight in gold on its own. So do talk to them about what they like and stuff, and don't be afraid to shop around, because it's your business and this needs to work for you. So do talk to 2 or 3 and get a feel for what they're offering.
Yeah, and going also, I think it also depends on your stress levels and how worried you get about doing your books at the end of the year or end of the month or end of the week. So those are the sort of decisions you've got to make, you know.
And a lot the people that I talk to, they fall into usually at least one of 3 categories, and they are the people that just don't have the time to do it.
Yeah,
you know, it does take time, and some people just don't have time to do it. There's other people that don't really understand it. They don't have the knowledge. They've got the software and they want to click here and there, but they don't really understand how it all works. And so that's when we get issues with accuracy and what have you. And then the third type of people are people that just plain don't enjoy working with numbers. And you know, not everybody likes working with numbers, and people just get completely turned off by it. So, you know, at the beginning I said about that sentence I read about accounts being the most dreaded word. I'm sure it is for some people because they just don't like numbers. But there are people out there that love doing this sort of stuff and will help you out.
Yeah. Have we got time for a few questions?
I have.
Brilliant. Okay, there's been a few rolling in whilst we've been talking. First one here from Linda. She runs a small business and says, is it necessary to have something like QuickBooks or Sage, or will spreadsheets be sufficient for her?
It depends on the size of your business. You can get by with spreadsheets. There's nothing wrong with doing this on spreadsheets. There's no law that says you have to use specialist software. But what I would say is, as I mentioned earlier, this making tax digital is a big push from the government. If you're VAT registered, you'll need to be submitting that through probably specialist software, and other forms of tax will come on board with that soon. Well, over the next probably 4 or 5 years, I would guess, you'll need to make that transition to specialist software, or find a way of getting your spreadsheet to talk to HMRC.
Now, I know Linda personally, and Linda is retired, so she receives a state pension, but she also has a business which she receives an income from. So another question she had was, does she need to pay national insurance if receiving a state pension, and is also a sole trader?
That's a good question.
You stumped.
Can I get back to Lynn, because I know that you won't have to pay any, you don't pay any national insurance on your pension.
Yeah.
I don't think you will have to do, but I will double check, because I just want to clarify about the class 4 stuff. I don't think you will have to pay any national insurance, but let me double check, and I will feed that back to Bill, and maybe Bill, you can.
Yeah.
Okay, I'll just make a quick note of that.
Yeah, that's fine. Yeah, if you feed that answer back to me, then I can let Linda know, because like I said, I know her well. But we also do have an accountant coming on in a couple of weeks' time as well.
Yeah, well, it'd be interesting to hear what they say about it as well.
So Laura runs a limited company, and she was registered May 2020. When would she need to submit her first tax return?
So I am not one of the bookkeepers that will do corporation tax returns at the moment, but I understand that it'll be 12 months from when you started. Yeah, so
it'll be bang, won't it?
It will be end of, what's the month before May? April, end of April this year. So next month. So you won't have to submit your tax return next month, but the figures that you put into that tax return will be made up to at the end of April. I think you have 9 months to submit the tax return.
Okay, cool. Got a couple of questions about sole trader going into a limited company. So when should you move from a sole trader to a limited company? And then Kirsty kind of follows that question up saying, how do you manage that move from a sole trader to a limited company in terms of expenses? You know, is it become a messy period? Do you have to shuffle money over from your sole trader to your limited company? Do you have to lend it?
So if I take the second question first about moving money around, effectively what you're doing, as a sole trader, you are the business. And when you start a company, it's like a newborn child. It's this separate legal entity. And so what you would probably do is take money from your sole trader business and invest that into the company. And that would be like startup capital, I would suggest.
So would that go into your director's loan account?
It could do. So a director's loan account is where you can essentially take money out of the business, but you have to pay it back come the end of the year. So if you put money into the director's loan account, then that has got a positive balance, and you can draw down from that. It's good. It should be zero by the end, but you could leave some money in the business. So you might just want to note that as capital invested, because you get it back at the end anyway, if that makes sense.
It won't disappear, but accounting wise, is it going to be messy, or does she need to get a little bit of help just to sort out the figures on paper?
It shouldn't be that messy. Like I say, I'm not a bookkeeper that does the corporation tax side of things. I can't imagine it would be that messy, because you would just close down as a sole trader, and that's quite easy to do. You would take out the money that you've made from it, and then you would start afresh with a new company. But you can move some of that. If you've built up like a stock of equipment and some stuff that, like, things that's not money that you're going to be using, then you might want to seek some advice around how best to absorb that into the company, because these would get listed as assets. So if you've invested in equipment as a sole trader and you intend using them within your limited company, then you might want to seek some advice around how best to transfer the ownership from you to the company.
Yeah.
And then,
And
sorry, the other question was when to move to being a sole trader from
a sole trader to a limited company. Difficult one, that.
Well, it is, it depends on why you want to become a limited company. It's not something that you have to do. But from my point of view, limited companies can come across as more professional, so you might want to do it for image. It depends on who your clients are. As a pet groomer, I don't think it will make that much difference. Some people do it for tax purposes, and it's so complicated. It depends on your circumstances. If your only income is from your business, if that is literally it, then probably the number where you want to start thinking about becoming a limited company over a sole trader is actually probably around £50,000 profit. Below that, you might be slightly better off as a limited company, but you have to bear in mind the added responsibilities that you have as a director. So the end of year accounts, the stuff that you have to do with company's house. Probably you will almost certainly have to hire an accountant to help you out with your end of year accounts. So, that might be several £100s, which is an added expense that you perhaps wouldn't have to have if you're a sole trader. But one of the other advantages, of course, of becoming a limited company is it kind of gives you a decent level of protection with regards to the name of your business as well. So there's lots of things to work out. If you're looking at it purely from a tax point of view, then I recently sat in on a webinar from a tax professional. In fact, this woman wrote the book on tax, and she went through the comparison of a sole trader and a limited company, if that is the only income. And it was almost identical up to about £30,000, and it was after you get to 30,000 up to about 50, that's when you perhaps want to start thinking about it. But the difference in how much tax you pay is actually less than, probably it's around about £1,000. I think it's not that much, and when you have to maybe spend several £100s on an accountant doing the end of year stuff, it might not be worth it.
Okay, so food for thought, lots to think about there. And the last one was, we were talking about the categories. What category would insurance fall into? So on the chart of accounts.
Yeah, so that's quite an easy one. That would just go into the insurance category. You'd have an insurance category for that. You might want to have one, and you can have like sub accounts. I didn't go into this, but you can have sub accounts. So you might want to have sub account for vehicle insurance, professional indemnity insurance, public liability insurance, any other insurances that you have. You might want to keep track of them separately, but they would all be housed together under an insurance account.
Cool. Okay, that's all the questions that have come in. So thank you for answering those. Thank you for your time Sunday evening.
Yeah, it's late now.
I know, heavy subject for a Sunday evening, but hopefully all this will be, all this is kept on the Facebook page, on the Facebook group. So, if you go over it a couple of times and try and understand it and get your head around it and look at it and watch it and digest it, watch it a few times, and then hopefully it will start helping you with your own business. But when I came to look at bookkeeping, I weighed up, the amount of time that I have to spend on it versus the amount of money it would cost me to get someone else to look at it. And for me, outsourcing it was probably the best thing that I've done so far.
Yeah, and so yeah, glad to help. Listen, if you're watching this on now and you want to email me directly, there's my email address. If you're watching it on replay, it's fine. You know, this is going to stay here forever, so I'm not planning on going anywhere. Please email me. I'm more than happy to get back to you, and I'll help you out if I can.
Brilliant. It's been really interesting. I've even still learning lots from it, going through it over and over again. I still get to learn stuff as well. So thanks for your time, and hopefully people will find some real good value in this. Thanks a lot.
See you later. Thanks very much, Bill.